Hello, everyone. Welcome to the class today. Today, we will be looking at the rest of the sections which we discussed last time when we spoke about you know, uh, the different sources involved, and we spoke about the risks in general. But I will be in detail covering up the topic today. So, when looking at the learning outcomes, we have actually covered in full when it comes to the learning outcome 5, right? So we've spoken about the finances available. Today we will be covering up the rest too, the risks involved in the range of sources of finance, and then we will be looking at the cost involved in managing the global risk, which would be the international risk. So those contexts will be covered. We will also be looking at the learning outcome 6 today because it has a connection with the learning outcome 5, which is the risk mitigations and the analysis of global risks and how it could be managed, and how could the work could be improved. So we will be looking at all those aspects today. So we are almost nearing to the completion of the learning outcomes. So once we finish all the assessments, I would surely discuss in detail, or provide some sort of a guidance with regards to the briefs as well. So that will be done. So we will be going forward with the lesson today, and we will cover the rest of the units. Okay. So far we've covered up until the sources of finance. I've explained about the different sources of finance and so on and forth. We've looked at the long term, short term, all those aspects. So now we will be moving ahead with the risks involved. Let's look at what are the risks involved and how it could be managed. Because when there is a risk, it's always important for the businesses to make sure that they have proper strategic plans in solving the concerns, because if in case the concerns cannot be solved, that's going to be a problem in going forward with any sort of a project, or when it comes to business, things like that. So it's very important, as identifying the different sources of funds. Even last time when we discussed, I explained how the sources of funds should be, addressed, because you can't say that you want, okay, I'm going to go for a bank loan, and you cannot just go for a bank loan. That's not going to be possible, right? You need to make sure that you, as a business, as an individual, maybe as a manager or a financial analyst, you make sure that you have assessed the decisions, you have addressed the pros and you have addressed the cons of it, and then you come up with a proper strategic decision. Because if in case you do not, then there will be problems in repaying the funds that is taken, which will affect the longer term growth of the business, the sustainability of the business, the competition. You cannot cover up your costs. They're going to be increased in expenses, which in turn would result in losses and so on and forth. So we saw these things detailed last week. So now let's go ahead with the risks. Okay. Okay, so we will be covering this section, guys. Right. So here we will look at the risks involved in the sources of finance. So we discussed about different sources. So we're going to address the risks involved here. So first, risks involved in taking overdrafts. So like I explained previously, overdrafts are like short-term elements which could be taken really fast when you have a business. So, okay, let's look at the risk in here. I slightly explained that as well, but at this session, we'll be discussing that as the main focus. The interest charged on overdraft cannot be predicted as it depends on the interest rate that varies and on the overdrawn amount on each day of the changing period. So this is a complication because you cannot actually understand where you're heading towards, right? Because you want to take some money, you want to borrow some money out of the bank, but then you are not aware of the interest rate. And it also depends on the overdrawn amount. And it is, of course, changing. So you cannot actually plan on it. So that is a disadvantage because you can't plan on your way forward, right? So that is one of the major disadvantages because when it comes to taking long-term loans, you will have uh, you will have a calculation. And of course, if it is a changing, if you are going ahead with a fluctuating interest rate, then that's going to be a problem. But however, if you are not going ahead with a fluctuating interest rate and there's a fixed interest rate, that's going to be a major benefit because even with the time goes on and if there is inflation or anything as such, it's not going to affect. But in overdrafts, there is such a risk where the interest charged on overdrafts cannot be predicted. So the organizations cannot plan on it. However, they are in situations where they have to take up overdrafts in order to manage the business activities. Okay. Then the next thing would be entire amount may not be given by the lender since the financial status of the business is considered. Okay, that is, they will look at the financial position. So the entire amount may not be given because, for example, as a business, you have some business activity to be done. In order to complete the process, you need maybe, we say, 50,000 pounds. Okay, that's your money. That's the money you want. But then you cannot plan that you might get all of it in the overdraft as the form of overdraft because the banking decision will depend on the status of your business. How far have you guys how far has the business been paying up any sort of money that's taken before, and the profit statements, the annual reports if it's available, so and forth. Those details will be taken into consideration and they will be discussed with the banks. So only then they will decide on what sort of an amount will be given. In majority of the cases, the banks will not give the entire thing that the business asks for. So it actually something the business has to plan on because if they are in a need of wanting exactly 50,000 pounds, they might put up saying that they want 70,000 pounds or something so that knowing their business capacity, then the banks would come up to a level where they would say, okay, we will give you 50,000 pounds. So it's actually something strategically that needs to be thought in a business point of view. But you have to keep in mind as an overdraft, the financial institutions just do not give you overdraft just because you ask the entire money. The entire money is not given, but of course the analysis is not. Okay. And the next point, if the respective organization fails to pay the interest charges, this can lead to a fall in credit score. So this is a problem because when the organization fails to pay the overdraft amount that is taken, then it is going to result in a fall in the credit score. So there is something called the crib. So they will be going into the crib. So there is a problem there. And this also will be taken into consideration when decision making is done, right? So it's very important. Therefore, when any sort of funding is taken by a business, It is considered and then it is repaid back on time so that they do not have a negative implication when doing future projects and business activities. Okay, so these are the risks involved when it comes to overdraft, taking up overdrafts. Okay, so these are the risks involved when taking short-term loans. High interest rates because it's short-term. Of course, if you go ahead with the long-term, the interest rates will be less because you are paying for a longer period of time. Because this is being repaid in a shorter period of time, the banks would charge high interest rates. When compared to long-term loans, these loans charge a high interest rate. When looking at the long run, business pay more money on interest. Exactly. Because it's an interest charge. You don't exactly pay what you get for, but then you end up paying something more. But of course, you are going ahead with the loan because you do not have the facility, or even though you have the facility, you do not want to dump all the money into one project at one go. So you are taking up this way forward. Okay. Higher levels of scrutiny. These loans are unsecured loans and more susceptible to default. Okay. Therefore, the credit history of the borrower will be heavily scrutinized during the lending process. So do you see the similarity here? It's something similar to the overdraft, right? Because they are susceptible. It's the same thing that we discussed in the overdraft as well. Because these are unsecured loans. They can just take up the short-term loans and they can just, vanish. So therefore, their credit history is checked, and then that is what will be heavily dependent. That decision will be taken into consideration by looking at the credit history. Okay. Failing to pay back, the short-term loan will put a negative mark on the credit score, which will affect the ability to obtain a long-term loan in the future. So there is a problem, right? Because when they fail to pay the short-term loans, then that would have a very negative impact on the credit score, which will affect the long-term loans or any sort of funding they would require from a financial institution. So that is a risk involved when it comes to short-term loans. So it is all dependent on the payability of the organization. So it's very important that the organization pays it back so that they avoid any negative future complications when such, loans are about to be taken, right? So this is about trade credit. Okay. The risks involved in trade credit. First, bad debts. When suppliers offer goods on credit, I'm assuming that you are aware of the concept trade credit, like we discussed in the last session. So bad debt is when the supplier offers goods on credit, there is a potential that it might become a bad debt in which will affect the profit of the company. So now you are giving products on credit, expecting that they will pay you back later. But when in case they become bad debts, it's when they are not able to pay you back, they become the bad debts. So that will affect the profit of the organization. Then no guarantee. There are no guarantees since the buyer pays late. Okay. And loss of discount. Opportunity of receiving an early payment discount will be lost. Okay. So that's a risk because you are buying it on a credit basis. You're not going to get any early discounts. Loss of relationship. If the buyer fails to adhere to the agreed trade credit conditions, they will lose their supply. Okay. Because if you as a person, you've taken something on trade credit, you're supposed to repay it back. If you don't repay it back and you become a bad debt, you cannot again go to that supplier, okay, in order to purchase products. So that's going to be a negative impact. There's going to be relationship issues, okay, and this will also in turn affect your long-term business plans because maybe the person you are getting the goods from is providing you quality products, but then because of this financial concern, you cannot move forward. Okay, so there is a risk involved when it comes to the trade credit. When I'm explaining these things, make sure that you take into consideration in a business point of view and a buyer point of view as well, so that you will be able to understand both the scenarios, so that it will be easy for you when you are writing up your assignments as well. Okay. Okay, now we will look at the risk involved in short-term operating lease. There will be fluctuations in the residual value of the leased property. Okay, so these are lease properties that you are trying to take. Okay, so but this is for short-term operating lease. So always consider when it comes to funding, you always understand the long-term and the short-term aspects. So there will be fluctuations in the residual value of the leased property. One thing is it's short-term. The risk involved in factoring and invoice discounting. So this is another source. So we saw factoring and invoice discounting. Factoring fee could be high if the organization's consumers or customers do not have a reliable history of paying bill on time. Okay, so what is basically factoring? Where your receivables, you are giving it to another party to follow up and get the payments from that. Maybe you are supposed to pay them, but you're not paying them on cash, but you are factoring out, okay, your receivables. So the factoring fee could be high if the organization's consumers do not have a reliable history of paying bill on time, because that's a risk, right? Suppose I have, okay, so I need to pay back to company A, right? And then I have the receivables. These people are supposed to pay me. And what these people say, so what I'm going to do is, instead of paying them on cash, I'm going to give the contract to them to follow up and get the payments from the people who I am supposed to follow up and get. Now, these people, if they do not have these people or these consumers, if they do not have a good, reliable history of paying bills on time, so the factoring fee on me will be high. Okay, so there is a risk there. In case the client does not pay the invoice, the factoring company will hold the respective organization responsible for the advance, which will affect the cash reserves of the company, right? Then they'll have to pay back in cash. So that's going to affect the cash reserves of the company. So it's quite direct, okay? Now we have the risks involved in equity financing. Okay. Success of the company is crucial for investors as their payment is highly dependent on the success of the company. Okay. If there is no growth or profit in the company, it will result in an adverse or negative effect on the payment possibilities of the investors. So it's about the equity financing, no? So it will wholly depend on the profit and success and the growth of the organization. If it's affecting in a negative way, and of course the payments are going to be affected in negative way. There'll be no dividends paid, and then their rate would go down. So things like that will result in complications for the business. Then we have risks involved in debt financing. Too much of debt will not look good on the company, as the company will be labeled as high risk by potential investors. So what would happen? They would not buy the shares. They would not be willing to be a part of the investor group. Okay. Debt financing will make the business difficult to expand because of the high cost of repaying the loans. Right. So these are simply direct risks involved when it comes to debt financing. Risks involved in preference shares. If the interest rates of these shares decline, the issuer of preference shares may decide to purchase back the existing shares in order to issue new shares at a lower rate. So that's a devaluation happening there. The value of preference shares can be reduced due to inflation. Okay. Because last time also, when we were addressing the sources of finance, we saw the difference between ordinary shares and preference shares, which has more power, more voting rights, like has voting rights, and so on and forth. So preference shares will have immediate effect when there is inflation taking place. Because in case you buy at a price, when there is inflation, when you want to like sell it off also, or get even or give it to a certain individual, it's going to be at a lower rate. Okay. Right. So here we will be looking at the cost of capital. Cost of capital is the return any investors would expect for the investment of capital made. So it's basically the return. Such investments include all sources of capital, equity shares, common stock, preference shares, bonds, and any other long-term debt. The return any investor would look when making an investment includes the following: return on risk, return on inflation, and the return for patience. An organization's cost of capital is the overall or average cost of capital in which each category of capital is proportionately weighted. All capital sources are included in calculating the weighted average cost of capital, right? So this is basically the theoretical aspect here based on the cost of capital. We will also be looking at the calculations. So before that, companies' assets are financed by either debt or equity. Weighted average cost of capital refers to the average of the financing cost of these sources. So it's the average, okay? Each of which is weighted by its respective use in the given situation. A company's weighted average cost of capital is the overall required it's the overall required return on the firm as a whole. And as such, it is often used internally by company directors to determine the economic feasibility of projects, expansionary opportunities, and mergers. It is the appropriate discount rate to use for cash flows for risk that is similar to that of an overall firm. In the early slides, each source of finance has been examined in isolation. However, the practical business situation is that there is a continuous raising of funds from various sources, of course, because you cannot just depend on one, but of course you need to have a mix of different sources of funds when it comes to a huge amount. Funds are also used partly in existing operations and partly to finance new projects. Okay, that depends from one business to another. there is not normally any separation between funds from different sources and their application to specific projects. Companies' assets are financed by either debt or equity. I think it's repeating. Okay, so this is what it is. To find an average cost, the various sources of finance must be weighted according to the amount of each held by the company. All right, so this is about the average cost here, right? The various sources of finance must be weighted according to the amount of each held by the company. The weights for the sources of finance could be book value, which is the represents historic cost of finance, and the market value, which represents the current opportunity cost of finance. When using the business value, reserves such as share premium and retained profits are included in the business value of equity in addition to the nominal value of share capital. When using the market value reserves, such as the share premium, retained profits are ignored as they are in effect incorporated into the value of equity. This is the same with debt. Market value should be used rather than business value of the debt. So here is the steps involved. Step 1, you calculate weights of each source of capital as mentioned above, and you estimate cost of each source of capital, multiply proportion of total of each source of capital by the cost of that source of capital, and then you sum the total in step 3 to get the weighted average cost of capital. So the calculation is here for you guys. Okay, so you can actually have a look at this or take it into notes as well. Okay, so that's about the cost of capital calculation. Now we will be looking at the global risks. Global risk is, we've also covered this concept when we were discussing about the globalization elements and stuff, because global risk mainly takes place for a business organization which involves an international operation involved. So we will be considering when we will be considering the international operations, and we'll cover the global risk element in here. So risk can be defined as an unrealized future loss arising from the present action or inaction. Risk can have an adverse or a favorable impact for an organization. When we talk about risk, when we consider risk, or even like when we mention the word risk, it's always about adverse effects, right? So why, but however, it also has a favorable effect in terms of um, the thinking, which has changed an adverse event to a favorable event. Because without a risk element, without an organization experiencing risk, how could it even know what sort of decisions to be taken, or its next stage, next approach. All these things depend on the risks involved. Only if there is a risk element that is being experienced, you will be able to understand, okay, we have some sort of a complication there. And that complication, we need to come up with strategies in order to overcome the complication. So when in the process of overcoming the complication, concern, or even we call it the risk, the businesses will be in a position to find a favorable impact through effective decisions being made. If there is no such element as risks, the business would not involve in analysis. Analysis meaning the addressing of the situation, addressing of the business situation. So they will not know what is happening internally, they will not know what is happening externally affecting the organization. So they cannot come up with effective decisions. So risk has resulted in adverse effects too, but also has played an important role in addressing favorable impacts as well. Okay. And risk is also quantifiable with possible outcomes that have associated probabilities, thus allowing the use of mathematical techniques. Okay. Okay, give me a minute, guys. Right. So we will look at the types of risks. So the risks can be classified as the strategic risks. In short, this is the risk that affects the overall mission of the company. The risks focus on the most significant aspects of an organization, which deals with the concentration of resources, mergers, acquisitions, and exit strategies. We actually saw about the strategic approaches. When it comes to, we saw about mergers, acquisitions, post acquisitions, and everything. So that is a strategic move. So there is also risks involved. So that is what they mean here about the strategic risk, because a business can make different strategies, but however it cannot all the strategies cannot result in some sort of a betterment. Of course, there will be problems which could be internally or which could be externally. Therefore, it's important for all the organizations to make effective strategic decisions based on suitable analysis. Okay. The next thing would be the operational risk. Operational risk is sometimes known as the process risk. It can be defined as the risk from the loss from a failure of internal business and control process. So in its name itself, you can actually understand it's about the operations. So you have a business and you're ongoing some operations. It could be day-to-day operations. So when there is a failure taking place in the operations that's ongoing, then that would result in certain risks. If, for example, your departments are connected, or you have a manufacturing plant and you have a process involved, there should be a step 1, step 2, step 3, right? So in case there is some sort of a halt taking place in the step 2, in which case there's a risk involved, you cannot move on to the step 3. So there is a problem there. So that is a different type of a risk. That is what we call as operational risk. Okay. Okay, now this section, risks can be classified in various ways, which include financial, product, legal, information technology. So these are basically the different departments. Operational, fraud, and reputation. The risks businesses face will vary greatly between companies and are derived from a number of sources. Below are some of the risks that affect a business. So the risks can take place in terms of different elements, which could be financial, product, legal. Suppose you have a faulty product produced, so that is also a risk because you can't sell it, right? So there are different elements involved. It's just not one aspect, but then you will have many other different aspects as well. Product risk, this is the risk that consumers would not purchase new products or service, or that there would be an unexpected decline in the sales demand. A new product introduced in the market may fail to achieve the expected sales or might be slower than expected. Okay, so that is a risk because you have a target. As a business, you will have a target in your mind and you would want to achieve that. And you would, you would have studied the market, you would have understood the demand, you would have assessed what the needs of the people are. So you, as a business, you've done your analysis, but still there could be instances where the decision making could go wrong. And maybe because it's about the taste and preference, right? So because this is something we study in economics, and when we study supply and demand, an element which would determine a demand would be taste and preference. So you make up a decision based on that, and then you develop your products or services. Suppose if the taste and preference of the people changes, or some sort of a competitor coming into place has a better product, in that case, what happens is you will be falling into a risk, right? Because there is slower demand. Although you made decisions sometime back when the demand was really high, but then now the demand is really slow, so that would actually create a product risk. Next one would be the market risk. This is the risk which derives from the sector in which the business is operating and from its consumers. This risk can apply to resources, production, capital market, and liquidity risk. This is quite direct. This is about the market risk involved. Right. Next is the legal risk. This is the risk of litigations or legal action against the company. Ethical concerns. Maybe you produce a product that is not according to the ethical standards, that's going to be a problem, right? Businesses that fail to comply with law run the risk of legal penalties and also accompany bad publicity. If you don't consider ethical aspects, and if you don't maybe produce goods and services that are not ethical, or maybe you use child labor, right? There are a lot of cases if you go into Google and search about child labor, because that is something that's not accepted, but majority of the multinational corporations, especially who are involved in mass productions, okay, they are involved in child labor. So if you go into, type Marks and Spencer or anything as such, anything that has manufacturing impact, they will surely have some sort of a case going on in terms of child labor. So that is a legal risk that is against the laws and regulations. It's against ethics. So that would result in bad publicity. The key areas include health and safety, environmental legislations, consumer protection, where child labor comes, data protection, employment issues, and so on and forth. Okay. And then the next would be the political risk. This is the risk where political actions can affect the functions and values of an organization. Stability. If you remember, I was talking about the political stability and things like that. So that would also have an impact on the risk. It would create risk actually when there is no political stability, you have an unstable government and things like that. There's so much of risks involved as a business person, because you cannot make effective decisions and you do not know where you're heading towards. Okay. Then technological risk. This is the risk where rapid change in technology can affect the organization. Technological risk is a two-way risk, as such changes create both threats and also opportunities for an organization. Some other technological risks are data and system integrity risk, internet risk, denial of service attack. So these are all risks involved in terms of technology. Although technology is widely needed, sometimes it can also cause problems. For example, hacks, viruses being transmitted, which completely makes your system problematic. You can't move forward after that. And then it could also result in, sometimes sometimes for organization, the tech is not needed. It's not much of a necessary, but however, because of the competition element, it would result in technological risk. So that's why it creates opportunities, but at the same time, it would also create threats. Okay, so that is one part of the threat. Then we have health and safety risk. This risk involves loss of employees' time due to injury and also have to pay compensation on legal cost due to breach. Health and safety risks involves due to the following. They arise due to the following, which is lack of health and safety policies, especially when organization doing mass productions, and when developed an organization in the developed country moving into a developing country, these things are of a major concern, because they do not provide proper health and safety guidelines to people. Like, those are all problematic things, because if something goes wrong with an employee, the companies cannot, like, they have no way of saying, okay, we did this and it's not our fault. It would be their fault if they do not have proper health and safety regulations and policies set up in their organization. Lack of emergency policies, poor health and safety culture, poor employee welfare, where they cannot support. Okay, so these are risks. Environmental risk. This is the risk or loss to the business due to its operations having a negative impact on the environment. This risk is greatly present in the agricultural and farming industry, chemical industries, and transportations. This is about the emissions, guys. This is about you have these things being manufactured or being used, but then it also has an environmental impact. The chemicals and everything which are not used being thrown into the sea and the rivers and things like that, that's causing environmental damage, right? The fishes are spoiled, and there were there were also where in big containers the oils that's being transported, sometimes there's oil leakages and everything, so it's affecting the nature is being affected. So that is the risk involved here. Then we have the fraud risk. It is common that losses through fraud of the employees, including management, is visible in most organizations. So all organizations face this kind of a risk. Fraud is common. Okay. So there cannot be one specific thing, because especially when it comes to finances and everything, the fraud element is more. You have a lot of cases when it comes to the fraud risk that's being taking place. So you can always Google and check for case studies, because those are of good readings, because you can use those as example when you are developing your assessments, which would enhance your relevance of information and your the value of it, right? Right. So this is about the different types. So we have here, okay, let's look at this aspect. Financial risk, this is the major cause of a business risk and can be further classified as gearing risk and liquidity. Gearing risk, this is the risk of having a high financial gearing exposure and a large amount of debt. So your business basically has a large amount of debt. Liquidity, this is the risk relating to the deficiency in cash inflows to fund operations. Types of financial risks. Credit risk. A credit risk arises if a customer or other counterparty to a financial instrument fails to meet the contractual obligations. So it's about a contract in between two people. Credit risks arise principally from accounts receivable to a lesser extent from other third-party contractual financial obligations such as other financial assets, shorter bank deposits, and derivative financial instruments. Without taking into account any collateral, the carrying amount of financial assets and accounts receivable represents the maximum exposure to credit risk. Right, so this is a type of financial risk. Then we have liquidity risks. Liquidity risks arise not from having the necessary resources available to meet maturing liabilities with regards to timing, volume, and currency structure. This is basically where you do not have assets which could be liquidated soon. Okay. Liquidity risk becomes particularly important to parties who are about to hold or currently hold an asset, since it affects their ability to trade. Liquidity risk is usually found to be higher in emerging markets or low volume markets. Liquidity risk tends to compound other risks. So it's basically where you cannot actually liquidate quickly, where you cannot sell something and make it into cash. Currency risk arises from exchange rate moves between pairs of currencies, where the fluctuations takes place. Interest rate risk, the risk that your investment's value will change due to a change in the absolute level of interest rates. In the spread between two rates in the shape of the yield curve or in any other interest rate relationship, interest rate risk affects the value of bonds more directly than stocks. Okay. Then we have the exchange rate risk, the risk that exists when financial transactions is denominated in a currency other than that of the base currency. So if you have a low value currency, that's going to be a problem because you'll have to pay more, right? Probability risk, this is the risk of unethical behavior by one or more persons of a particular process. Example, victims of bribery or corruption. Right, it's about unethical behavior. Reputation risk. Loss of reputation is a great risk to any company. Of all other major risks, reputation risk is one of the most strongly correlated to other risks since its level partly depends on the likelihood of other risks materialize. Okay. So because that's something which is major. If you lose the reputation of your organization, it's very difficult to build up the goodwill. So stability, growth, selling off, everything affects if you have a reputation problem, right? Okay. And then we have entrepreneurial risk. This is the necessary risk associated with any new business venture. Example, an investor fails to deliver required returns due to competitors' activity. That's because if you are not competitive enough, that's going to create entrepreneurial risk there. Because you need to compete as a business, your competition never ends. Every day you need to compete because there are common things coming up. Even if you are in the education industry, you are in manufacturing, even if you are you see sometimes even catering and things like that, everywhere there is competition. Even you develop a unique product, still there would be competition arising because you, as a matter of introduction of your organization or a company or a unique product, you are giving out the information. So another party would get that information, come up with the same product, which should be a substitute. So that's going to result in competition. Then there is economic risk. This refers to risks facing organizations from changes in economic conditions, such as economic growth, economic recession, taxation policies, unemployment levels, and international trading conditions. Right. The next would be risk mitigations. Right. So we all this time we saw about the risk. Now we will be looking at the risk mitigations. Right. But we will be looking at this section next week. So I'm going to stop with this. We've discussed about all the risks. So next week we will be looking at how and in what ways we could mitigate or control the risks. Okay. Right. So yeah, I will see you guys in the next class and we will continue further. Okay.